Well, hello, Maverick traders. This is Robb Reinhold, and welcome to Secondary Indicators, Truths and Lies. All right. As I was building this, I wanted to make this super dramatic, even though it's not very dramatic. But, it's one of these things where when you get into the world of trading, and I remember when I started trading, it was in the late 90s. And there wasn't a whole lot of books out there about trading, but there were some books about trading. And I got really involved into technical analysis, and I got a hold of books like, Robert Prechter's Elliott Wave Theory, and I got into, Nissen and his candlestick charts, and I loved it. And I read these books like they were the Bible, like they were the encyclopedia. And this was the truth. I was finding the truth. And all I needed to do was follow these truths. And my trading would be fine as long as I followed these truths. And I think it was a experience where a lot of times, like when you go to college and you go to business school, and they tell you all the things in business and how business is going to work. And then you go out into the real world, and all of a sudden you realize, wow, you're not really prepared for business. Even though you took all the business classes, you learned all the things you need to learn, in the real world, it doesn't really work like that. And this, to me, was exactly how it worked. I learned about these secondary indicators. I went out and I took them out into the real world, and they failed. And I couldn't understand how they could fail because it was the truth. I got them out of the Bible. I got them out of the trading Bibles. Steve Nissen, Robert Prechter. This was the Bible of trading. And so I really wanted to develop this class to really talk about really the good and the bad about secondary indicators. Because inevitably, you probably have already gone out and used some of these and found out, hey, and sometimes they're absolutely wonderful. And sometimes they are perfect, and sometimes they're great. And then sometimes they fail horribly. And I think going out there with the perception like I did, that this was the truth, that this was how it worked, really set me up for some failure. So I wanted to do a session to really kind of walk you through kind of what I experienced, and to where hopefully you don't have to do that as well. Now, for some of you who have already gone down the path that I've gone down, you probably have already experienced some of the things that I've talked about. And so really, I want to just make sure everyone understands secondary indicators and how they should be used. All right, so let's start off talking about what are secondary indicators. Now, a secondary indicator is simply a formula. It's somebody who is way smarter than me, has looked at things, and they've developed a formula. Now, the cool thing about secondary indicators is some of these formulas were created specifically for the financial markets. And some of these formulas have been around for years. One of the things that we use is Fibonacci. Fibonacci is centuries old. And so there's lots of things that people have used to basically take the numbers of a financial instrument, put it into a formula, and it spits out a number. And that number, that line, that dot, whatever it creates, basically is a visual picture of what has happened based on this formula. And so indicators can be used for many different purposes. And this is one of the big things where I'm going to talk about today is the purpose. You can use it for trend continuation. There's some indicators that work very well to tell you, is the trend about to end? There are some indicators that are very good that are in reversals. There's some indicators that are very good that work well around support and resistance levels. So what you're going to see is that most indicators will work well in a certain environment and fail in others. That right there is probably the biggest one, and that's what I'm going to spend the majority of our time on in this session. Right, so if we take a look at the categories, again, they break them up into categories. And these are just some of the major categories: momentum studies, pivot studies, regression studies, volatility studies, volume studies, and then moving average studies. All right, so this is where there's a lot of redundancy. If you heard me talk about secondary indicators in any of our other sessions, I talk about and point out how much redundancy there truly is in the world of secondary indicators. There are now hundreds and hundreds and hundreds of indicators that measure momentum. Now, if you think about it, momentum is basically how strong is this trend and how long is this trend likely to go. There are hundreds of studies that have been developed to measure this momentum, but in the end, they're all measuring the same thing, price and volume. That's what they're measuring. They're just measuring it a little bit different. Again, volume studies, volatility studies, there's numerous amounts of these studies, but in the end, they're measuring the same thing, volume. They're measuring volatility. And so there's a lot of redundancy. And basically, all they are is just different formulas of how to measure what it is you're looking for. So here's the first thing I just wanted to point out, is that every single secondary indicator was developed to measure a certain effect. And it's been well done, it's been well written, it's been well researched to capture that effect. Here's the problem. It is not designed to capture other things. It's designed to capture certain things. And so what happens is when you read, trading books, and you find out and you first learn about stochastics, which was the first one that I was brought into. Man, I thought stochastics was the most amazing thing. What I didn't understand was that it didn't apply all the time. And that's what I tried to do. I tried to take this study, this momentum study, and basically apply it to every single trade I made. Now, of course, there were some times where I'm just not using the right thing. And there's some times where it worked out well. But at the time, I didn't understand that the stochastics indicator was built for one specific thing. And again, like I said, I was trying to apply it all the time, all the trades. And again, when the trends weren't moving well, I was still trying to apply this study. And again, same thing, regression studies. Regression studies are basically the idea of reversion to the mean. So how likely are these to revert or regress to the mean? In certain instances, that's fantastic. It works really well. But what about when things aren't in that environment? That study is going to fail quite a bit. So what I really wanted to talk about is when using secondary indicators. I always like to think of the right tool for the job. And, I use the term of golf to really, really make this make sense. Now, first off, I'm a terrible golfer. I actually only like to do Top Golf now. Now, if you don't know what Top Golf is, it's just a hitting range where you go to a building and they have a nice heated area for you to sit. They have food, they have drinks, and they have these targets out there that you just hit. There's no walking to the next hole. There's no this. And you can hit more golf balls in an hour than you can in 4 hours of golf. So that was my full disclosure on golf. That being said, your golf bag has different clubs. And your club, your driver, is for a specific part of the game. You can't use your driver when you're 30 yards out from the hole and you need to make a chip shot. You need to pull out the right club. And so to think of secondary indicators, I really want everyone to think about a golf bag. That you have this bag of tools, and in certain situations, that tool is going to be the right tool to use. So let's take a look at just some of the momentum studies. And again, I don't have time to go through the hundreds and hundreds, but I really am just trying to get you to the point where you can look at these things objectively. So let's just look at 3 momentum studies. These are fairly common. We have stochastics, we have the CCI, the Commodity Channel Index. It's something that I loved when I was a younger trader. I don't really use it that much anymore. And then we have stuff like the Relative Strength Index. So these are pretty common secondary indicators. And again, if you want to know what it is they're measuring, you know what? Google searches are fantastic. You can read these mathematic formulas. If you're good at mathematics, you'll probably have some understanding of what they do. If you are not good at mathematics, you probably just read on Investopedia what they measure. But you'll see here that here we have a pretty well trending stock. The stock was sideways for a long time and then really broke out and has just been really trending since then. Well, if we take a look at something like stochastics, and again, I'm not going to get into stochastics here, exactly how to read them. We have a session on stochastics. But in theory, stochastics should give a buy signal when they cross under 20. So down here is the 20 line, this line down here. You can see that it basically has never got below that 20 line in the last 6 months. So the stochastics was not giving any sort of signal. Again, RSI as well, not giving any sort of signal that you should buy or sell. The only one that gave you a signal was the CCI, and it gave you a pretty good signal. You can see that it gives you that signal right about here, and it leads to a pretty nice gain. So when you were looking for secondary indicators, and you say, let me see which one is going to indicate when the momentum in this stock DVD really takes off, well, CCI was the only one that gave you a signal. So the question is, okay, which one is going to be the right tool for the job? And that is really one of the hardest things about technical indicators. Now, if we take a look at the wrong tool for the job, well, we see that the stochastics and the relative strength index didn't really give us any signals. And frankly, the RSI and the stochastics. So again, let me quickly just break down RSI and stochastics. RSI says if when the RSI is below 30 and rising, it gives you a buy signal. When it's above 70 and falling, you should sell. And same thing with stochastics. When it's below 20, you should buy. When it's above 20, you should sell. Well, while the CCI was giving you a buy signal, the other two indicators were giving you a sell signal. Take a look as the trend was definitely to the upside. And if you were using stochastics and RSI, it actually told you don't be in it. It's overbought. And so as you can see here we're just taking a look at 3 studies. They're all in the same group. They're all supposed to be measuring momentum. And yet one is giving a buy and 2 are giving sells. So the question is, well, which one is the best one to follow? Well, guess what? You're going to see that there's some times where stochastics and RSI give a better signal. So here's a stock that is going mostly sideways. So we can apply momentum studies to sideways stocks as well. So when we take a look at, okay, well, what is the best indicator here? Well, look at CCI here. CCI gives you a buy signal basically right here. There's 2 days of upside, then it plummets. It gives you a buy signal right here, a sell signal right here, and it reverses. RSI, same thing, doesn't really give you good signals, but take a look at stochastics. Stochastics gave you a great signal to buy here, and it gave you a great signal to sell here. It gave you a great signal to cover and buy here. So as you can see here, we've got really good signals from the stochastics on this example. And the other ones basically failed pretty miserably. If you followed CCI or RSI, you probably did not do all that well, especially CCI really failed in this one. So we just took a look at a chart where the CCI was great, stochastics and RSI were no good. And now we're taking a look at another chart where the stochastics were the right indicator to use, and then the CCI was the wrong indicator to use. So hopefully you're starting to see that when you start to try to apply a secondary indicator across all of your trades, you're going to see that sometimes it's the right indicator, and sometimes you're going to get a great signal, and it's going to lead to a great trade. And then sometimes there's going to be a different secondary indicator that was going to give you a much better signal, but unless you were using it on all of your trades, you wouldn't really see it, and then you would basically get no signal or a false signal from the indicator that you were currently using. So let's get back to this. As you can see here, there are so many studies, and it's kind of an inside joke here at Maverick. Whenever we see somebody online that has posted a chart, and they have like 47 secondary indicators on their charts. Basically, you can't even see the price action of the stock because there's so much crap pasted all over the chart. And we've seen some pretty comical examples where it's so much. And obviously, you can't be running multiple secondary indicators. If you're running 20 secondary indicators, I'll tell you what, at any one time, you're going to get a buy signal on 5, a nothing signal on 10, and a sell signal on another 5. And all of a sudden, all that does is lead to confusion. So if you are going to be using secondary indicators, and we're totally okay with that, we want you to, first of all, understand what you're actually using. For example, let's say that you are strictly a trend trader. You are strictly a trend trader, and you are very directional in your trading, meaning you're trying to buy low, sell high, buy low. So again, your trades are going to make money primarily from movement. Well, all of a sudden, you need to really focus on the technical indicators that are going to be the best for you. The question is, are you even interested in volatility studies? And the answer is probably likely not. Are you interested in pivot studies? Well, maybe. This is where, again, you're going to get indications when things are moving, but you're not going to be interested in regression studies. So you need to understand, okay, this is my strategy. This is what I'm trying to do. And then you need to go find the right tools for the job. Now, let's say that you are more of an options seller. You're looking to make more money on stuff like theta. Well, then, you know what? Momentum studies don't really apply to you. You're looking at volatility studies, volume studies, and maybe some regression studies. The point is that you're getting the right tool for the job. There are hundreds and hundreds of technical indicators out there, and I'm sorry, but there's no way you're going to be able to learn all of them. So my advice is, if you are going to use some secondary indicators, really try to pinpoint what it is you're looking for. Understand, okay, I'm trying to be a directional trader, meaning I'm trying to get in, buy a stock when it's low, sell it when it's high. I'm trying to make money on direction, or if you are experiencing options, in delta. And then go and research the secondary indicators that are specific to what you're trying to accomplish, and ignore all the rest. Completely ignore the rest. So again, I want everyone just to understand what it is they're actually looking at. That's, again, the most common problem I see is that people don't use the right tool for the job, or they think that they can use their sand wedge on every single trade they make, or every single shot they make. All right, so let's get into the myths, the truth and lies. All right, now this is what really, really sold me early on. And I was a new trader. I obviously didn't have a lot of experience. And so when I came across these indicators to me were the answer. Okay, you don't have to be super smart. You just have to be able to tell when two lines cross. Now look, I'm not the brightest guy in the world, but you know what I can do? I'm really good at watching two lines and knowing when they cross. Watch, I'll do this right now. So here's one line. Here's another line. Look how good I am at it. Oh my gosh, I just did it. I just nailed it. I'm actually really good at that, and I can do that all the time. I know that is a sick brag. That is a very sick brag, but it's the truth. I can tell when two lines cross all the time. So I really grabbed onto these because they were simple, they were easy, you couldn't screw them up. When I looked at the candles and I looked at the price and the volume, and I thought, oh boy, that's definitely more complex. I'm going to watch these two lines when they cross. And the thing that really sold me on it was that when I looked back in history and I saw the signals that these secondary indicators generated, they were amazing. They were amazing. And I thought, oh my gosh, look, if I just bought when this line crossed, sold when it crossed here, I would make so much money. And so by looking back in the past, it convinced me that all I had to do was buy those signals. Here is the problem, and this is where, again, I call it truths and lies. Not really lies, but people don't understand it. Is that all indicators are made up of a study over a certain period of time. So if you want to look at the MACD, the moving average convergence divergence, there's actually 3 numbers that you're looking at. The first number is one of the averages, and the second number is another average. So if you put in, again, standard in MACD is 12 and 26. So what you are saying is you're saying, I want you to take an average of the last 12 days, and then I want you to compare it to an average of the last 26 days. And the third number is basically a correlation between the two. So you put in 3 numbers, and it spits out lines. Now, if you change those numbers, you're going to get a different line. So again, this is another problem with technical indicators, is that when you go in and you read up about them, they're going to say, okay, well, this is the standard. Well, that's the standard for their style of trading. If you are a trader that holds for a longer period of time, you're going to want to adjust numbers to be bigger. If you're a holder over a shorter period of time, you're going to want to adjust those numbers to be smaller. But the biggest question is, what's the right number for you? You don't know. You will literally have to go and do lots and lots of testing. But most people, they read some books, they say, oh, that's the standard number, and in your software, they actually will have the standard number. So if you wanted to go add stochastics, you would get a 9, 3, and 3. And that would just be the standard numbers that somebody decided years ago that you should use. That doesn't mean that's the best for you. And the one thing you need to understand, again, all indicators are made up of a study over a certain period of time. The number can be dramatically changed by the number tomorrow. And let me give you an example. Let's say that we took 10 days, and every day the number was a 1. Every day the number was a 1. So we had 10 days where the number was a 1. And so if we wanted to take a look at a 10-day moving average where we took all the days and added up the number of all the days, which we have 10 days with the number of 1, we would equal to 10, and then we divide it by the number of days, 10, we have an average of 1. So on today, we would see that the average number was 1. All right. Let's say that tomorrow the number is 11. All right. So the number dramatically changed to 11. So we lose the last day. So we have 9 days that are a 1. We have 1 day that's an 11. Tomorrow, when we look at the average, that average is going to double to 2. Now, that really doesn't represent the sample size, because 9 out of the 10 days were a 1. We just have one crazy day, and this changes it dramatically. And then 10 days later, when this 11 drops off, the number is going to change dramatically again. And so what you'll see is you will see that these lines will actually change. What was the number yesterday won't be the number tomorrow. That's the one thing you really need to understand about technical indicators, is that the number today will be changed tomorrow. The moving average of today, it'll be changed by tomorrow with the new information. All right, so let's just take a look at exactly what I mean here. And this is where, if you're watching this in real time, it messes with you. Now I'm going to take a look back at this signal that was left right here. And again, I'm going to point to, I think that's going to be March 23rd. Right, so you can see at this point right here, these two lines crossed, but then they actually flattened out. I can absolutely guarantee you that on this date, right here, the stochastic lines had crossed and were moving higher. Now, based on stochastics, that is a buy signal. You would have bought on this day. You absolutely would have bought on this day. The problem is, by the end of the day, and with tomorrow's candle, these lines will actually change and they'll flatten out. And all of a sudden, when you take a look back tomorrow, they never crossed. Hopefully that makes sense. because yesterday the lines were crossed. It was a clear buy signal. The price action changes, those lines smooth out, and then when I look back on it, it never crossed. It never crossed. And so when I back testing, that would never be an actual trade, when in reality, it was a trade. And if you made a trade here, you can see you would have bought up at the top of this, you would have likely had a loss. And then 2 days later, we actually get a cross that turns out to be a good signal. I'll tell you what right now, if you bought the first one based on the stochastics and got stopped out for a loss, you are going to be gun shy to buy the second one, which turned out to be the right signal. Turned out to be the right signal. Same thing here. We get a turn down on this candle. I can guarantee you that right here, these lines had crossed to the downside. What happened was we got a 1-day candle. It bounced up. They changed. They flattened out. And then the real short signal, when you take a look at back testing, happened right here, and it was a decent signal. You could have made some money. Let's take a look here at this signal. I guarantee you at this point right here, these lines had crossed and had moved higher. You would have bought on that cross. You can see the stock dropped from 265 down to 235. And then we got a cross. But if you look back, if you were to do back testing on this, you would say, well, no, I wouldn't have bought there because the lines never crossed. Yes, they did. They just smoothed back out. This is the stuff that, again, you take a look at stochastics. This probably crossed 4 or 5 times in here. But in the end, when you look at it in back testing, it just smoothed out. It just smoothed out, and you would say, well, it didn't really give me a signal until, back up here. That's not true. It started giving you signals every day for about a week or two to go short or to sell when the stock was still moving up. Again, whenever you look at these technical indicators, please look and see when they would have actually crossed, because they give you false signals all the time. Let's just go through one more example of this, because I really want to get this point driven home, is that there's a lot of false signals that if you really know what you're looking for, you'll see that, down here on December 15th, you got a clear signal. You would have bought here on this candle, and then you would have taken a loss. Again, there's false signals all over the place. This would have been a signal right here for sure. There's no question that would have been a signal. Told you to get out. Well, guess what? That was right when the stock was zooming from 120 to 135. If you were following the stochastics, you would have exited on this day. That would have been your exit point, and you would have missed out on a monster rally. So hopefully, again, when you look at these technical indicators and you go back and you do any sort of back testing, please see that you're not seeing what actually happened. So let's kind of wrap this up. How should you use secondary indicators? Now, let me be totally honest with you. I use secondary indicators a lot in the beginning, and I sat next to a really good trader at Maverick Trading, and he didn't have any technical indicators, any secondary indicators on this chart. And I thought to myself, and I would debate with him, I'm like, you're crazy. I don't know how you're doing it. And he was always buying the things that to me were overbought on stochastics. Again, stochastics, that was like my indicator that I loved. And the stochastics were above 80. And I was like, well, I'm not going to buy that. He just bought it. You're crazy. It's overbought. I'm going to buy the one that's oversold. What do you think happened? Let's see. The one that's overbought, let's see, it's really hot right now. It's in high demand. There's more buyers than sellers. When he bought it, what do you think happened over the next couple of days? Yeah, you're right. His trade went higher. I went out and bought the one that was oversold. I bought the one that had been sold down pretty hard. Right now, there's a supply and demand imbalance to the sell side, and it was weaker than all the other stocks. And I bought that one. Yes, turns out that one wasn't the best one to buy most of the time. Watching him really helped me understand that these secondary indicators were actually hurting me. And so I got rid of a lot of them, and it took me a long time to get rid of stochastics. But once I got rid of them, it really helped out, because what I was really going through was price action and volume. And again, I still use moving averages, but really that's it. Price and volume, the candles to me are the most beautiful things. So secondary indicators, they're actually not called secondary indicators. That's just what we call them. They're actually just called technical indicators. We call them secondary indicators because we want to drive home the point that they're secondary. They're secondary because the primary indicators are the most important. Price and volume. Price, volume, and the candlesticks. If you're going to use secondary indicators, they should be used as a confirmation. Just a confirmation. Now, again, I kept my secondary indicators on my screen for a while for confirmation. But here's the problem is that they sometimes ended up keeping me out of good trades. Like, for example, let me go back to Stochastics. I would find a high base breakout, just a beautiful high base breakout, and I'd look at Stochastics, and they were at 82. They were above 80. Now, Stochastics says when it's above 80, it's overbought. You don't want to be in it. You want to actually sell it. So the Stochastics would convince me not to buy that breakout. And guess what happened? It most of the time kept going higher. And the Stochastics actually ended up keeping me out of good trades. And so I kept my secondary indicators on my screen, and then I finally realized that they're actually hurting me because I wanted to use them as confirmation. But a lot of the times the confirmation didn't come, and so I didn't take the trade, and it kept me out of a good trade. So over the years, I got rid of all my secondary indicators. I do use them in Forex, and I use them in Forex for exits. I don't use them for entries. I use them for exits. But other than that, again, I really don't use them much at all anymore. Another important thing is if you're going to use them, make sure you're using the right tool. So again, the right tool. We talked about golfing. We talked about using the right club. Make sure you're using the right tool at the right time. Again, RSI and Stochastics are really good to get things that have had big pullbacks. So if you are doing a pullback strategy, then these are decent secondary indicators that you can use that will help you out. But the CCI is a terrible, terrible strategy to use. However, if you were to apply that to a high base or a low base, Stochastics and RSI are going to be worthless. They're actually going to tell you to do the opposite of what you should do. But the CCI is going to tell you when it's time to actually get in off of a high base breakout. So I just really want to admonish you, just if you're going to use them, make sure you understand what it is it's measuring. Make sure you understand how it fits in within your strategy, and don't use them if it doesn't match up with what you're trying to accomplish. So again, if you want to use Stochastics, again, I would only advise someone to use that on pullbacks, on pullback strategies. It doesn't make any sense to use it anywhere else. So just think about what it is you're trying to accomplish, what setup you're trying to do, and then do some research and find the technical indicator that actually works well with that setup. And then don't use that technical indicator with other setups. It's only specifically for that job. So if you're going to use them, again, understand what they are. Understand that they should only just confirm primary indicators, and then right tool for the right job. All right, I got a quick question before we wrap it up. My question of moving averages and volume as indicators. Now, look, I really like moving averages. And moving averages are, to me, they're so simple. And I know that they can get very complex, and I know that there's some formulas out there that make it complex, but I like to keep them simple. The slope of a moving average tells me the trend. It tells me the trend so quickly. Oh, let's see, the 20-day moving average slope is higher. It's going up. It's at least that's what it's been over the last 20 days. So again, I just love how simple moving averages are. Now look, there's different kind of moving averages. There's simple moving averages. There's exponential moving averages. An exponential moving average basically gives the highest weighting to the most recent day. So an EMA, an exponential moving average, will, again, take what's happened recently and score it higher than what happened further ago. Now look, in some instances, an EMA is going to give a better signal. In some instances, an SMA is going to give a better signal. It doesn't really matter as long as you understand how it's working with your strategy. So again, I really like moving averages. And again, all this does is it keeps me on the right side of the trend. And I've got some really simple rules. I don't go short a stock that's trading above a 50-day moving average, and I don't go long a stock trading under a 50-day moving average. It's the most basic rule of trading, but it's just saying be on the right side of the trend. As far as volume goes, I look at volume. I still have volume on my charts, and I still use it. But like I just talked about with stochastics, volume won't keep me out of a trade. It won't keep me out. It is a confirmation, and I like to use it as a confirmation, but it won't keep me out. So great questions on those. All right, well, hopefully that helped out, and I know I made it sound way more exciting, truths and lies, but it's my take on secondary indicators. Everyone, thank you for joining me. Take care.